It's so easy to just walk down a completely average street, right, past a completely average office building and entirely miss the fact that you are looking at a localized portal into a multi-trillion-dollar financial matrix.
Oh, absolutely.
Yeah.
We see the surface level, a frosted glass door, a generic corporate logo, maybe a sad desk plant in the window, and we just keep walking. We rarely stop to consider the sprawling, completely invisible infrastructure operating right behind that glass.
Or how it dictates the literal shape of the neighborhoods we all live in.
Exactly. We just don't see it.
Right. So take a completely average street corner in Glendora, California. Today, for this deep dive, we are taking a single, seemingly everyday local business, a mortgage broker operating out of a strip on Route 66, and we're using it as a magnifying glass.
Yeah, and we have a really interesting stack of sources on the table to help us do this, right?
We do. We're looking at official California Department of Real Estate regulatory records, direct materials from this specific local company called Village Mortgage, Inc., and raw data from a massive mortgage industry intelligence platform known as MODEX.
Which is where things get really wild later on.
Oh, totally. Okay, let's unpack this. And we are starting on that literal street corner in Glendora.
Right, because we are moving from the micro to the macro today. If you pull the state records on Village Mortgage, they aren't some marketing facade or a fly-by-night operation. They're a fully licensed, highly regulated entity.
I mean, looking at the DRE license ID, it's 022469994. For anyone keeping track, they have a spotless record. As of today, March 21, 2026, it specifically says no disciplinary action.
Which is important, right? Because what is vital to remember when we talk about these massive systemic financial systems is that they are driven by actual human beings, boots on the ground.
Yeah, real people. The records show the designated officer, Timothy Billy Joe, alongside the salespersons who are driving the day-to-day origination. People like Lin Bao, Yan Lu, and Shusi Sun.
Exactly. These are the localized nodes. These are the actual people moving capital through the San Gabriel Valley.
And when you look at their corporate materials, what they actually sell, they offer the exact sprawling menu you'd expect from a local broker.
Yeah, the standard toolkit.
Right. Conventional loans, FHA, reverse mortgages, jumbo, home equity. It looks like pretty standard stuff.
But what's fascinating here is that while they maintain that traditional menu, their real specialty, the actual engine of aggressive real estate transformation in their specific market, is their fix and flip program.
The fix and flip?
Yeah, they are targeting distressed properties across Los Angeles County, specifically in places like San Dimas, Covina, Azusa, and Laverne.
Which is something I want you, the listener, to really think about for a second. Think about those distressed properties or, this outdated post-war homes in your own neighborhood.
We all have them, right? The house that hasn't been touched since 1975.
Exactly. How do they suddenly transform into these highly valued, fully modernized homes with the open floor plans and the new roofs? It's not just elbow grease. It requires a very specific type of capital.
Right, which brings us to the core tension of local real estate speed versus risk.
Because why can't an investor just go to a standard bank to flip a house? If you are an investor looking at a tired, outdated post-war home that's been sitting on Arrow Highway for years, you can't exactly walk into a legacy bank and ask for standard 30-year paper, not on a house with a caved-in roof.
Oh, the legacy bank will run away screaming. Traditional underwriting is fundamentally backward-looking.
Backward-looking how?
Well, they want to see a trailing 12 months of pristine income, right?
Yeah.
They want existing equity. And most importantly, they're underwriting the asset exactly as it sits today.
Right, the current condition.
Yeah. So if the kitchen is gutted or the roof is caved in, like you said, the collateral is compromised, the conversation ends right there. The computer says no.
But this fix and flip loan that Village Mortgage specializes in, it operates on an entirely different premise, right? Because unlike a traditional 30-year mortgage that looks at your W-2s, these loans are based on ARV.
After repair value.
Yes. It's like, okay, here's a way to think about it. It's like getting a loan based on the butterfly rather than the caterpillar.
Oh, I like that.
Right. The lender is funding the potential, not just the present reality. It's like viewing a house as a venture capital seed round rather than, a blue chip dividend stock.
That is a perfect analogy. A conventional bank is buying the blue chip stock. They want guaranteed current value and a very predictable yield.
Exactly.
But the fix and flip lender is the VC. They are funding the post-money valuation before the product is even fully built. They see the underlying structural potential, and they're willing to finance that future reality rather than the present mess.
And when you look at the specific numbers the leverage Village Mortgage is offering, you really see how aggressive that VC mindset gets in real estate.
It's intense. Based on the sources, they're offering loan-to-value ratios LTV of up to 90% of the purchase price.
Which is already high.
It is. But the kicker, the really wild part, is that they will fund up to 100% of the renovation costs.
Right, up to 100%.
Up to 100%.
Funding 100% of the renovation is highly, highly leveraged. You are essentially floating the entire capitalization of the project's physical transformation.
You absolutely are. And the terms of the loan reflect that intensity. We are talking incredibly short terms, just 6 to 18 months.
Wow, not 30 years.
No, 6 to 18 months. And featuring interest-only payments during the construction phase.
Which makes sense, right? Because the investor isn't buried in principal amortization while the house is completely uninhabitable and generating literally zero yield.
Exactly. But I know what people are thinking when they hear 100% of renovation costs funded.
Right, because I want to dig into the actual friction of this. I think people imagine a broker just like handing a developer a briefcase full of cash at closing and saying, good luck with the new kitchen.
Not even close. I mean, that would be institutional suicide.
Right.
The mechanism that actually makes this possible without the entire financial system collapsing is staged funding, or what the industry calls construction draws.
Okay, explain the reality of that draw process, because that is where the sweat equity meets the capital flow. How does it actually work?
Okay, so the lender holds that renovation capital in escrow, right? They don't just hand it over. The developer goes in, tears out the drywall, fixes the foundation using their own initial liquidity or maybe a credit line.
So the developer fronts the initial work.
Exactly. Then they stop. They call the lender. And the lender sends a third-party inspector to the physical site.
To verify they actually did what they said they did.
Right. To physically verify that the foundation is poured, it's up to code. Only after that verification does the lender release or draw down the first tranche of that renovation capital to reimburse the developer.
Got it.
Then the framing goes up, another inspection, another draw. It's step by step.
So it is a constant cycle of execution and verification. And that brings us right back to that central tension we talked about earlier. Speed versus risk. If you are a developer in a fiercely competitive market like Los Angeles County, your primary enemy is time.
Time is literally money.
Literally.
Yeah.
You are paying holding costs, property taxes, and those high interest only payments every single day. That house isn't on the market.
Yep.
So if your lender is slow to send an inspector or slow to wire the draw, your contractors walk off the job.
Which is precisely why conventional banks fail so hard in this arena. Their bureaucracy simply cannot handle the velocity required to flip a house in LA.
They move too slow.
Way too slow. Village Mortgage, on the other hand, utilizes private lenders and specialized institutional capital. This allows them to underwrite and fund these tranches at the actual speed of construction, so developers can win auctions and start swinging hammers immediately.
Okay, I have to push back here, though.
Go for it.
Because even with stage draws, this is inherently incredibly risky.
Right.
I mean, you are handing out hundreds of thousands of dollars, often millions, considering we're talking about LA County based on a pro forma.
It's a projection, yeah.
You are underwriting a ghost, a house that does not exist yet. And you are giving this capital to people who are actively buying distressed or foreclosed properties.
Sure.
So if the local market dips by, say, 10% during that 12-month build, or if the developer misjudged the neighborhood ceiling, that post-money valuation just evaporates. The VC seed round goes to zero.
And risk profile is the entire reason hyper-local market knowledge is the supreme currency in this space. I mean, the source materials really emphasize this.
How so?
Well, Village Mortgage isn't sitting in a glass tower in Manhattan guessing what a renovated 3-bedroom will trade for in Duarte. They understand the hyper-specific zoning laws, the overlays on Foothill Boulevard.
They know the neighborhood.
They know exactly what local contractors are currently charging for framing per square foot. They know the ceiling of buyer demand in specific zip codes. They aren't just guessing. They are calculating.
So if a developer says, I'm going to put a $1.5 million modern farmhouse on this specific corner in West Covina, the local broker is essentially the immediate BS detector.
Oh, absolutely.
They know instantly if that street can actually support a $1.5 million comp.
Precisely. The local mortgage broker is the critical risk mitigant for the capital backing them. They know the appraisers, they understand the local permitting delays, they know which contractors actually finish a job on time.
Right.
They are calculating risk based on granular localized data that a massive detached algorithm might miss.
Okay, here's where it gets really interesting. Because if I'm an institutional investor in New York or a massive private equity fund providing the liquidity for these California flips, I need to know that my local brokers are actually performing,
You need proof.
right? I need to know that Village Mortgage isn't just talking a good game, but actually closing volume and managing risk efficiently. But how on earth does the broader industry keep track of millions of local loan officers across the entire country?
That right there is the exact pivot point from the micro to the macro. We have to zoom out now. We have to leave that single office suite on Route 66 and look at the invisible overarching digital layer tracking this entire industry.
Right. And this brings us to our final source, which is this intelligence platform called MODEX. And there's actually a direct, literal digital bridge from Village Mortgage to this massive platform.
The NMLS ID.
Yes. On Village Mortgage's contact page, you will find their company NMLS ID. It's listed as 2546318 and also 2549318. That ID number is essentially their digital passport. It's the unique identifier that plugs them directly into the MODEX ecosystem.
And the scale of that MODEX matrix is genuinely staggering once you realize what you are looking at. I mean, founded in 2015, this platform isn't just a basic database to drive the industry forward. It is a live, breathing surveillance system of the U.S. mortgage market.
It's huge.
We are no longer talking about a few offices in the San Gabriel Valley.
Yeah.
MODEX currently tracks 1.47 million individual loan officers.
1.47 million.
Across 104,980 branches, encompassing 29,080 distinct companies.
Wow.
But the dollar volume, that is what really illustrates the systemic weight here. MODEX is actively tracking $16.38 trillion in mortgage transactions.
Trillion with a T.
With a T, alongside $6.93 trillion in MLS listings.
$16.38 trillion. But let's clarify the mechanism here, because this is wild. How exactly is a private tech startup tracking the individual performance of 1.5 million loan officers? Because they aren't relying on these brokers to manually upload their resumes, right?
Yeah.
Or self-report their closed deals.
No, self-reporting is inherently flawed and biased. People exaggerate. MODEX synthesizes this data by scraping and cross-referencing massive public and private data sets. They pull county recorder deeds, they ingest MLS feeds, they track origination data, and they use those NMLS ID numbers, like the exact ones we saw on Village Mortgage's site, to tie every single recorded transaction back to the specific human being who originated it.
Wait, so it is an automated dragnet.
Completely automated.
Every time a deed is recorded at a county clerk's office in California, MODEX's system parses the document, finds the loan officer's ID, and updates their profile on this massive leaderboard in real time.
Exactly. And the primary consumers of this data are employers in institutional capital in the mortgage space. It's a tool for them to hire the best loan officers by getting key mortgage, real estate, and consumer insights.
So they can see exactly who is performing.
Right. It allows companies to recruit the best originators based on undeniable empirical metrics. You don't have to guess who the top producer of fix and flip loans is in a specific zip code anymore.
You don't just look at their LinkedIn profile.
No, or take them out to lunch to gauge their confidence, right? You just look at the raw data of their trailing 12 months of closed volume. And it also works the other way. It allows loan officers to stay anonymous while looking for better opportunities to maximize their success.
Okay, but I have to ask, is this just a glorified corporate matchmaking service?
What do you mean?
Like, is MODEX simply a highly efficient HR tool for recruiters to poach top talent? Or is it fundamentally changing how capital itself moves across the country?
Based on the source material, it is far beyond just a recruitment CRM. They explicitly provide solutions spanning the entire industry. We're talking wholesale lending, non-QM strategies, business development, and regulatory compliance.
So it's much deeper.
Much deeper. Think of it this way. They're taking the raw, scattered, localized performance of over 1 million professionals and turning it into organized, actionable intelligence for the entire macro financial sector.
They're essentially mapping the genome of the U.S. mortgage market.
If we connect this to the bigger picture, this is the realization that local brokers like Village Mortgage do not exist in a vacuum. A team working out of a local office, dealing with local contractors, inspecting local foundations, they are simultaneously active, trackable nodes in a $16 trillion network.
Every single deal matters to the algorithm.
Yes, every single closed fix and flip deal in Covina instantly becomes a permanent data point on the MODEX platform. And that informs the systemic capital markets about the velocity and the safety of that specific neighborhood.
So what does this all mean? We've covered a massive amount of ground today.
We really have.
We started by looking at a single physical business suite on Route 66 in Glendora. We unpacked the friction and the mechanics of ARV-based financing, how 100% renovation loans operate like venture capital seed rounds to breathe aggressive new life into distressed properties across LA County.
The butterfly, not the caterpillar.
Exactly. And then we zoomed way out to see how every single one of those localized high-speed transactions and the human professionals behind them are being autonomously tracked and cataloged by a multi-trillion-dollar data ecosystem called MODEX.
And honestly, I hope it forces you to view your own environment through a completely different lens.
How so?
Well, the next time you see a coming soon sign go up or a chain link fence and a dumpster arrive in front of a newly modernized post-war home in your city, you won't just see a construction site anymore.
Right.
You now understand the specific tranches of capital being wired as those framing milestones are hit. And you understand the vast invisible data networks working behind the scenes to track the exact alpha of the broker who made that flip happen.
It is the perfect distillation of how modern capital actually functions right in our own backyards.
Which leaves us with one final, highly systemic implication to consider based on these sources.
Lay it on us.
If platforms like MODEX are already comprehensively tracking the exact performance, the underwriting speed, and the localized transaction history of millions of individual loan officers in real time,
Yeah.
how long will it be before predictive algorithms, rather than local human relationships, start dictating exactly which neighborhoods and which specific local loan officers are the safest bets for private capital?
Wow. We may be rapidly approaching a reality where the data matrix decides exactly where the money flows long before the local broker even picks up the phone.
It's something to think about.
It really is. Well, thank you all for joining us on this deep dive. Keep questioning the hidden systems operating right in your own backyard, and we'll see you next time.